We will be now discussing some strategies which are market neutral. Many a times we have been in a situation where we initiate a trade after all our conviction and study, either on the buy side or on the sell side. And right after we initiate the trade, the market moves just the other way round. Yes, most of us have been in this situation, and all our strategies, planning, efforts and capital go for a toss. In fact, this is one of the reasons why most professional traders go beyond the regular directional trades and set up strategies which are insulated against the unpredictable market direction. So strategies whose profitability does not really depend on the market direction are called market neutral strategies. Let us understand some of these market neutral strategies and how a regular retail trader can execute such strategies. Let us begin with a long straddle. Long straddle is perhaps the simplest market neutral strategy to implement. Once implemented, the profit and loss is not affected by the direction in which the market moves. The market can move in any direction, but the point is that it has to move. As long as the market is moving, irrespective of the direction, a positive profit and loss will be generated. To implement a long straddle, all one has to do is to buy a call option and buy a put option, both at the same strike price. The important point to be kept while initiating a long straddle is that both the options belong to the same underlying and both the options call and put belong to the same expiry. So they belong at the same strike price, same underlying and same strike price. Let's understand this strategy with the help of an example. Now if we have a look, Nifty spot is trading at 10,360. We want to buy both a call option and put option at the same strike price. So normally a straddle is carried out at the money strike price. So if we look at here, 10,350 is an at the money strike price. So we buy a call option paying a premium of 111 rupees and simultaneously buy a put option of strike price 10,350 paying a premium of 95 rupees. Let us see what is the payoff of this strategy as we ahead expiry. So as we can see here, C plus 10,350 at 111 premium, P plus at 10,350, premium being 95. These are the different spot prices and scenarios which may occur at the expiry. These are the payoff diagram which will pay off from a call option position, and this is the second leg of the strategy which is the payoff from a put option. This is the combined PL from the strategy. Now as we can see here, if the price is remaining between 10,350 and 10,200 and 10,450, we see that we are constantly incurring a loss. This is exactly what I had mentioned, that if we are initiating a long straddle, what we are expecting is that the market should move from the time at which you have entered into the strategy. So the market has to move either on the upper side or on the lower side from 10,350. As the price goes lower, say 10,100 and below, or higher 10,550 and above, we can see a positive PL. The graph of a long straddle is shown like this. As we can see here, if the market is ranging between this area, there is a negative payoff, and if the market considerably moves on the higher side or on the lower side we have a positive profit generation. So let us quickly sum up this example. The maximum loss from this particular strategy is the net premium outflow. Since you are a buyer of a call option and buyer of a put option, you are paying a premium, and as we know that for a buyer of any option, the maximum loss which he or she can incur is the premium amount. So the maximum loss which is incurred from this particular strategy is the premium which has been paid at the time of entering into the strategy. So the net premium outflow will be 111 plus 95, which makes it a total premium of 206. So the maximum loss from the strategy is 206. What is the maximum profit which can be from this strategy? As the price goes above a certain level or below a certain level, there is unlimited gains. So maximum profit would be unlimited as price rises or falls. We need to calculate the two break-even points from which the market should go up or down so that we can generate a positive profit and loss. So the upper break-even point would be the strike price at which we have entered the strategy, that is 10,350, plus the maximum loss or the premium which we have paid. So 10,350 plus 206, which makes it 10,556. That is the upper break-even point. The second break-even point, the lower break-even point is strike price minus the maximum loss or the premium which we have paid. So it is 10,350 minus 206, giving us a total of 10,144. So in our example which we have discussed, the market has to move either above 10,556 to give us a profit or below 10,144 to give us a positive return.